I look at JP Morgan, like I look at all these, Citi too. There's going to be a tale of two cities, which is that there's before the vaccine and then after, though Citi believes that it's going to roll out more slowly. JPM, I'm just going to say this was one of the greatest quarters that I have ever seen. And the stock was justifiably up. And then Citi reports and people said, And then Wells Fargo reports. And Charlie Scharf, who runs Wells Fargo, is not a promoter. He's an operator, and he told it like it is, which is he still is nowhere near where he wants to be, and that's why that stock is brought down.
All right, y'all, we're back on the road. We're back on road, as they say, road to a million. Episode 4, mile marker 4. We've got a couple of things to discuss in this episode. I've got a quick portfolio update for you guys. We're going to touch on who the best and worst performers are in my portfolio and why that is. And then we're going to go over some options trading basics. A lot of you guys hit me up about how I use options trading in this road to a million, how I get the proceeds or the money that I make from options trading, how I add it into my passive income, my dividend income portfolio, and most importantly, I think a lot of you just want to know what options trading is and how you can get into it. After I posted that screenshot of the $1,200 that I made doing a play for Amazon, a lot of you guys sent me messages, a lot of comments. So we're going to touch on options trading. But let's get into this quick portfolio update. This week has been a pretty good week overall for my portfolio in the market. You see on Thursday, I broke the $8,000 mark and then kind of dripped down a bit below it, closing today out at the end of the market, at the market close on Friday. So I'm right there at about $8,000, still super proud of all this progress. This is $8,000 in growth from side hustling, portfolio growth, everything that's been done basically from July 1st to this day. So it's quite astounding that just putting in some effort, putting in the work to come up and build up an $8,000 portfolio. So let's touch on what we're talking about today. Who are my top performers and who are my bottom performers in my portfolio? So we'll start off by taking a look. You guys can get a quick glimpse of all the different holdings that I have here in my portfolio. You see there's a wide variety of companies, and I just want you guys to get just a quick view just in case there's any types of stocks or companies you might be interested in researching. But let's check this out. Okay, let's check this out. The number one performing company in my portfolio, when sorted by total dollar amount gains and losses, is LTC Properties. I've done an episode about them being the number one performing stock in my portfolio, so you can go back and check it out to learn more about them. Coming in at number 2 with $34 in gains is JP Morgan, followed by AbbVie. And it's very interesting to me that these are the top 3 performers as sorted by dollar amount in my portfolio, because they all operate in very distinctly different sectors and industries. LTC, as we already know, is a healthcare REIT, so they're in the healthcare / real estate industry. JP Morgan, as we already know, is one of the nation's biggest banks, followed by AbbVie, which is a huge biopharmaceutical company. So those are my top 3 when sorted by dollar amount, total gains and losses. But another very interesting thing, or another interesting way to look at top performers and bottom performers in a portfolio is to also look at your list, or to look at your holdings when sorted by the percentage of total gains and losses. So when we sort my portfolio by percentage total gains and losses, we see that the Bank of Montreal is in the number 1 spot with just over $17 in gains, followed by Chevron with $28 in gains, and then coming in at number 3 is a company by the name of RioCan, which is a REIT, real estate investment trust from Canada. So I want to focus this episode though on talking about JP Morgan. They've had a little bit of financial news, and if you haven't already been aware, if you don't know, we're going to dive into that a little bit and kind of understand what's going on with JP Morgan as a bank, as a business structure, and most importantly as a dividend holding in this portfolio. So we see here that I purchased shares of JP Morgan Chase December 30th at the end of the year, as well as January 4th at the beginning of the new year 2021. And each time I made purchases, you can see just based off of the performance that I've had a positive gain and positive growth, capital gains with my performance in JP Morgan. This portion right here has gone up $13. The next time I bought, it's went up $10, and the next time after that, it's went up another 11. So the purchase price and the price appreciation, as they call it, the price gain has gone up pretty well based on the timing of when I bought JP Morgan starting in December 30th. But we really want to check in. Let's get in deeper as to what that means and what's attributing to that. But we always start off with Seeking Alpha, just to kind of give us an overview as to the dividend side or the basic side of that. And let me take a note to say this. You don't have to use Seeking Alpha just for your dividend analysis or your dividend summary. You can use it for all kinds of things. As you see here, they've got news, they've got SEC filings, press releases, their financials. So it's a pretty great resource when you just want to get to the bottom line numbers of how a company is doing. But as we just saw in my portfolio, I got shares of JP Morgan at December 30th. And we can take a look here on Seeking Alpha that around that time, JP Morgan was trading at $125 a share. And the company is now up to $138. So within a matter of a few weeks, they've price appreciated about $13, which is quite awesome. But we're going to dig in even deeper and really figure out the answer and the reason why shares of JP Morgan Chase have gone up in value so much in a short amount of time. But before we take a look at that, we're going to check out just the dividend information so that we're all on the same page about why it's in my portfolio and the type of dividend activity you can expect to see when dealing with JP Morgan. So here we're going to take a look at the dividend scorecard here on Seeking Alpha. And we see that currently JP Morgan is trading at $138 a share. They are paying a 90-cent dividend per share that you own. So every one share you buy at this price, you're going to get 90 cents. They had a recent ex-dividend date of January 5th. And if you were able to get shares before this date, you will get the dividend payout at the end of the month, January 31st. Okay, so some key numbers to understand, and I do have an episode about understanding the dividend scorecard, but for those of you that are new, I just want you to take a brief moment to vibe and tune in with me here so you can understand some of these basics when dealing with this scorecard on Seeking Alpha. So one of the most important numbers we want to take a look at is what is called the payout ratio. And just to keep it very short, the payout ratio is basically the amount of money a company pays back in dividend income to their shareholders from every dollar that they make. So you can look at it in this way. If JP Morgan makes $1, they're having to pay back 38 cents of it back to their shareholders in dividend income. So the closer this number is to 100%, it is more of a red flag. It's more of a bad sign. When you're looking to invest in companies that pay dividend income and you're wanting to grow that side of your portfolio for passive income, you don't want this number to be close to 100. Just as a general rule of thumb for myself, I keep the number at about 65%, no more than 70 at the most, but I like 65 and below. So they've got a really, really healthy payout ratio of 38%. And then we got some more important numbers to take a look at here. It's their 5-year growth rate. So over the past 5 years, JP Morgan has increased their dividend payout. They've increased this number 16% over the last 5 years. And this is extremely important because what a lot of people do as they grow their passive income portfolio, you want companies that are going to increase their dividend payments to you. This is a great way to have your passive income constantly stave off the negative effects of inflation, which eat away at people's money, eat away at your health. And you'll see that's why having your money in a regular savings account at the bank that's paying you little to no interest on that money is not a good idea. You want to put your money in companies that are increasing their dividends, because this number here is helping to preserve your capital, it's helping to preserve your income as inflation prices increases or inflation rates increase across the country and across the world. Next, an important number to take a look at is their dividend growth over X amount of years. Now, according to Seeking Alpha, JP Morgan has been increasing their dividend amount for the last 10 years. So this is really dope. And we can take a look here and just kind of verify that with this dividend history option here. So we get a quick overview over the last 5 years based on the quarters. You see that back in 2016, JP Morgan was paying a 44-cent dividend per share. So you see, this is extremely important because if you're building your passive income portfolio and the price of inflation or the rates of inflation are increasing, you want your money to keep up with that. You see, the next quarter they increased it to 48 cents. And then you keep going, and then by 2017 they were paying 50 cents a share. So you can see here quickly that 2018 they just been increasing it, they just been increasing the dividend. So this is a great way to make sure that your money is working for you and keeping up with the current inflation rates and market conditions. And then even better, you can actually see a real breakdown when they declare their dividend dates here, the ex-dividend dates, and as well as the pay date. So you see, as you just scroll through further and further into the past over here on this side, that JP Morgan has definitely been increasing their dividend, and they've been consistently paying it without fail for a long time. I mean, this data just goes back all the way to 1996. It appears that seeking alpha has. So you just look and you can see JP Morgan has just increased, and it's very important. Even more so when we take a look in this year, right? 2007, 2008, going into 2009. This is when the housing crisis happened. This is when the entire American economy was upside down, and JP Morgan still consistently paid dividends and increased dividends. So it's good. It's good. We see a little bit of a dip here, but they bounced back, and they were very aggressive at increasing their dividend output, increasing their dividend payments to their shareholders. So we see that overall, JP Morgan has a really strong dividend, but that does not explain why the share price is increasing. And the share price increasing has attributed to being one of the top performers in my dividend income portfolio, my passive income portfolio. So we want to look at some factors as to why the share price has increased about $13 in the last few weeks going into the new year.
JP Morgan kicking off the buyback train, Leslie Picker.
Hey, Sarah, a big announcement and a big number here for buybacks, $30 billion. According to JP Morgan, they plan to begin share repurchases in the first quarter of 2021, and they're going to maintain that quarterly common stock dividend of 90 cents per share for the first quarter of 2021. This is due to the green light, of course, that the Fed said that they could begin share repurchases given the latest stress test, the second stress test of the year. That stock popping on that news, up more than 5%. So clearly shareholders are excited by the prospect of share repurchases resuming. Guys, back over to you.
So we just saw from CNBC that the Fed is allowing JP Morgan to do $30 billion worth of share buybacks. So they're repurchasing their own shares that are out on the open market and buying back themselves and taking ownership of those shares. The first thing to understand about this is what causes a stock to increase in price and what causes a stock to decrease in price, to go down in price. And so, long story short, one of the basic fundamental factors that affects a share price is supply and demand, right? So when there are more people in the open market that are buying shares of a company as opposed to selling shares, the price of that stock goes up. More demand, higher the share price. Conversely, or on the opposite end, when there are more people selling shares of a company as opposed to those buying it, so more people are selling, that means, or that causes the share price to go down. The demand is low. So that right there affects the general share price of a company amongst many other factors, but one of the basic fundamentals is supply and demand. More people buying, it goes up. More people selling, it goes down. Now you can start to put two and two together. So the Fed has permitted JP Morgan to buy back $30 billion worth of its own shares. So with such a large amount to be able to be purchased by JP Morgan, that is causing the stock price to constantly increase. And what we saw from the end of 2020 going into these few weeks of this new year already, JP Morgan has climbed $13 and is constantly growing up from that. And that is the primary reason why JP Morgan has climbed to that number 2 spot in my portfolio for its performance. The ability for the company, for the bank to buy back its own shares, $30 billion worth, is causing an increase in value. Now, you take a look here on Investopedia, and they have a great article that goes into why a company would buy back its own shares. But the key takeaways right here is that companies do buybacks for various reasons, including company consolidation, equity value increase, and to look more financially attractive. So as the bank, JP Morgan buys more of its own shares back and the stock price begins to increase in value, there will be other public shareholders, other market players that will see that increase and want to buy more shares of the stock thus increasing the price and the value of the shares even more. So that's why JP Morgan has shot up to number 2 in performance in my portfolio. The share buyback program allotted or permitted by the Fed has given it a great boost in its performance and its stock appreciation, its price appreciation. Now, let's take a look at who is at the bottom of this list. Which security, which holding, which position do I have that's been the worst for me so far since I've got shares? And as you can easily see here, at the bottom of my list is Costco, which, to be honest, was really surprising for me. But in hindsight, I've learned a lot about why this position is so underperforming for me, why it's at the bottom of my list. And even when I sorted between percentage of total loss and gains, Costco's still at the bottom. And even when we do dollar total loss and gains, Costco's still at the very bottom. So no adjustment in any way that I look at it, whether it be a literal dollar amount or a literal percentage amount, Costco's still at the very bottom. We see that Fidelity does a summary, does an analysis saying that overall I was paying about $387 per share to get into Costco, and Costco's now trading at about $362. So a pretty significant drop. And I was getting shares of Costco back in the last part of November 2020, and you can just see here from this shot that every time I went in and bought, the price just dropped more and more and more. Now, I'll be completely honest, one of the things that I've learned in hindsight after this time has passed is I got into Costco because they had announced a special dividend of pretty much $10 per share. So every one share that you own of Costco, you would get a special dividend of $10. Now, the most important thing that I've learned since then, and I've done this with a few other companies, is that when businesses announce a special dividend for their shares, for their shareholders, the stock price normally goes up by that amount or even more. So when Costco made the announcement that they were going to have a $10 special dividend, the stock price just popped. It just boomed off and it skyrocketed. And getting in at that moment in time, as we see, wasn't the best decision for my overall price appreciation or the overall performance of Costco in my portfolio. We see that each time, November 20th, the 23rd, 24th, 25th, I was really hustling up, trying to buy as many shares as I could from all my side hustles to up my position in Costco so I can take advantage of the special dividend that they were going to be paying out. But that isn't just the only reason why the share price is underperforming, where I paid for it on average $387 a share, and now Costco's trading at $362. There are some other factors that go into why the share price has been coming down from the time that I bought into the company, and we'll take a look at that right now. And here is a big reason why I believe the share price of Costco is underperforming, or why over the last couple of months it is trended downward, especially after having a spike when they announced their special dividend of $10 per share. Warren Buffett and Berkshire Hathaway have sold out entirely of its stake in its holding in Costco. So they sold $1.3 billion of Costco shares back to the open market, which to me indicates why the share price has gone down. It's kind of like the opposite of what happened with JP Morgan. JP Morgan has taken $30 billion to buy shares, which is increasing the demand and causing their share price to go up. On the flip side, we've got Warren Buffett selling shares, 1.3 billion selling shares through Berkshire Hathaway, and that's causing the demand to go down. And because the demand is going down, the share price is going down with it. And so that's the main reason. We've got the spike because of the special dividend, and after shareholders are paid their special dividend, a lot of times they sell their shares. And then we've got Warren Buffett and Berkshire Hathaway selling $1.3 billion in the Costco shares out, and that also causes the share price to go down. So these are just a couple of the factors that are the most prevalent in my mind as to why the timing of me getting into Costco in terms of building a position wasn't great at all. It's the selling of shares from Berkshire Hathaway, the spike from the special dividend. All of those things are causing shares of Costco to slide. Now, this in by no way, shape, or form indicates that Costco isn't a great company. A lot of people know that Warren Buffett and Berkshire Hathaway, they invest with a strategy of extreme long term. where they see the overall industry and the market going. Some people believe that they think that Amazon is going to be the dominant play to kind of take over the arena that Costco's operating in. I don't necessarily believe so. But I do believe that this big sell-off, as well as the special dividend that was announced, that was paid out, shareholders have gotten the dividend, they've sold their shares back, or they sold their shares out. That is why Costco is sliding down, and it is the worst performing stock. It's my worst performing holding in my overall portfolio. I don't know exactly if and or when I will sell out of my position. I've been thinking that once I get back to the break even point, I might get out of Costco and take those funds to buy more shares of companies that have been constantly performing, like LTC. Maybe even get some more shares of AT&T because they have a great dividend payout set up right now. They're trading at about $30 a share. So I'm not exactly sure, but I do believe these are the two major factors that are causing Costco shares to go down. I think there are a lot of people that follow Warren Buffett and Berkshire Hathaway's trading positions closely, so that when Berkshire Hathaway sold out 1.3 billion, I firmly believe that there were several other players on the market that sold out of their positions too, mainly because there are a lot of people that kind of mimic or follow Warren Buffett and Berkshire Hathaway's trading plan, their investment plan, I should say. They follow exactly what they do. So when Berkshire Hathaway sold out, several other people sold out of their positions and their holdings in Costco. Well, that's been a quick look, you guys, at the worst and bottom performing holdings in my overall portfolio. Hope you guys took some notes. Of course, if you have any questions, if there's anything you want to know more of, if you want me to go more in detail of, don't hesitate to hit me up. I love when you guys ask me questions. I love the comments. I love the feedback. All right, y'all. Peace.